Good afternoon, everyone. I'm John Garcia from PSE's Market Education Department, welcoming you to another PSE Stock Market webinar. So today we will discuss one of the most unpopular topic in investing, bear markets. So the continuing drop in prices made a great number of our investors worry about their portfolios and has even sparked the questions whether to magbenta ba, no? Or to hold on to the investments, or even to try to buy the dips to lower their average costs. So indeed, the words bear market strike fear into the hearts of many investors. These deep market downturns, while unavoidable, actually present opportunities for existing and prospective investors. Sabi nga ni Alexander Pope in his poem, a little learning is a dangerous thing. Kaya nga kailangan importante para sa ating mga investors to have a better understanding about bear markets, how to prepare for it, or how to act when the market enters such a cycle. First, tanungin natin ang ating mga sarili, are we really in a bear market? Is this another bear market? Or are we just experiencing a market correction on our way to recovery? So we invited the resource speaker from First Metro Investment Corporation to answer these questions and to share some investment strategies that can be applied during this market cycle. Before we proceed to our webinar, here are a few reminders for our participants. Please remember that in this webinar, the presentation is for educational and informational purposes only. So this should not be construed as a professional, financial, or investment advice or recommendation from the PSE or from our guest speaker from FMIC. Now, as mentioned earlier, we have invited a guest from First Metro Investment Corporation to be our resource speaker today. Allow us to introduce her first before we go to her presentation. Our speaker this afternoon is the First Metro Investment Corporation First Vice President and Research Head. FMIC is a prime mover of capital as well as a catalyst for economic growth in the Philippines today. She is a resource person in the FAMI Investment Committee and a member of the FMIC Investment Committee and FMIC Capital Markets Development Committee. So Ms. Christie completed her Master in Business Administration degree from the University of the Philippines under the UP-MBA Scholarship Grant and obtained her degree in Economics from the UP School of Economics. Ladies and gentlemen, let's welcome ang nagbabalik sa ating PSE webinar, si Ms. Cristina S. Ulang with a virtual round of applause. Good afternoon, Ms. Christie.
Hi, good afternoon. Happy to be here, John. And good afternoon to everyone. Of course, it's PSE, so I have to be there. It's for market education, yeah, and the greater good of all. We should all learn and be smart in the changing world of investment. Capital markets are evolving, so I'm going to present our view, our recommended strategies, hopefully to maximize our gains and whether navigate the tricky environment now with greater clarity in our head and greater understanding of what's happening around us. So let me share my screen.
Okay, Ms. Christie, the floor is yours. Take it away.
Okay, so is it visible now? Is everybody able to see? Not yet. Okay, sharing.
Yes, we can see the slides.
Okay, yeah. So this is a black swan, a big black swan. You see here Mr. Putin so angry and the US president also so angry. And my topic is about investing in a bear market. It's not just investing. I want to change the topic. It is successfully investing in a market that's correcting and suffering from all of these headwinds around us. So day one of the US-Ukraine war, oil breached $100 per barrel, crypto sunk, and then the ruble was suspended, gold was up. So what do all of these things mean? It just means that it's risk of some kind of risk of environment for investors. Investors are wanting the safety of gold, the safety of US Treasury, safety of dollar. So what do we do in order to be able to maximize our gains, the upside, and spot opportunities and seize them when they come? So here are some tips. But first of all, let me first some introduction here, some kind of mind setting short speech. Okay, successful investing is what we need, not just investing. It must be purposeful, meaningful, and not blind. So we should be investing with our eyes open. We should have access to the best investment infrastructure, institutions, and resources giving us the right advice. We should acquire the right mindset so it reduces our mistakes and develop some discipline in the way we conduct ourselves in our trading, in our investment decision. We should keep educating ourselves because education is just the start. Smart, creative, and we should be embarking on a never-ending journey of thinking about market possibilities, identifying and seizing the opportunity. So that is the exciting part. Okay, so let me first define what do we mean by bear market. Bear market is a 20% correction or a decline of the main market index from the recent peak. Our recent peak was like 7,500. So where we are now, we're in the 6,500, 6,600, and that is not a 20% correction. So we are not in a bear market. We are just undergoing a correction. And the history has been, I'll show you, this is the slide that tells us that in 2006 and up to 2008, that was the financial crisis, we had a 61% decline in the main market index, you'll see here. And that happened over a period of 1 and 3 months. So it's a very long period of decline, but we recovered, and we recovered over a period of 6 months. So the same thing happened again in the 2008 crisis. It's another crisis period. And the decline of the market happened in 1.5, almost 1.5 years. And then we had a longer recovery, 9 months. So we saw again a sharp decline when the COVID pandemic happened, first quarter of 2020, and the GDP of the country shrunk. We had a recession. We dropped GDP growth, sunk to negative 10%. And no wonder the PISA also moved very much lower. So that happened in the first quarter of the period 2020, and then we had this recovery until we reached a high of 7,005 in February of this year, and then we are now back to the 6.5 level, but very far from the bear market territory. So what's happening during bear market? Are they happening now? Are they similar to what happened in 2008 and in 2009? But I think my teddy bears are causing some distraction. They all came here when they learn I'm going to speak about the bear market. So they shouldn't be here. I should be setting them aside. After defining what a bear market is, these are all irrelevant. I don't know who sent them here. They're all from Grab or Lala Move. So let's see what's happening around the world, and domestically, what's the economic events that have pushed the market lower. It's the Fed rate hike. And it's happening today. So the Fed was tightening money supply conditions in the US because of inflation. So two elements: Fed hiking cycle, tightening the credit conditions because of inflation. That happened in 2008. It happened again in 1998 crisis. And the high Fed rates was at the level of 5.5. It rose to 5.25 in 1998. And then in 2008, it happened again from 1%. It rose to 5.25%. So very high, very tight for longer, over 3.25 years. So the tightening cycle is something that's very negative for markets, and it is happening now. You're seeing in the headlines, the Fed is going to hike the rates. And the BSP is now following. So the tightening of credit conditions negative for markets. So that explains the drop in the correction that we're seeing, and that's all in reaction to inflation. So rising inflation, interest rates, and economic decline. So these are the conditions that we are in now. They are a repeat of the history, 1998 crisis and 2008 crisis. We have not fully emerged from the COVID pandemic. We're very fragile still, although our GDP is 8.3%. Very good news for all of the market participants and for the markets and for investors in general. And of course, our credit rating agencies. So are we headed towards a bear market? I don't think so. And then before I show you my arguments, let me just say that, because of the conditions now, the flight to safety, the higher risk of sentiment, cash is no longer king. This is now the byword. When you put your money in bank nowadays, you lose money because inflation will just erode the value of your cash. The time deposits just making how much? 25 basis points per year. So you should be making the most out of your cash. Don't put your money in time deposits in savings account if you want to maximize your gain. Cash is not king. Okay, inflation is the killer. That is what's going to erode the value of your cash. And is that the fault of the central bank or is it the fault of Putin? Let me show you the background. So prior to the pandemic, there was economic growth. There was no need to loosen up monetary conditions. But when the pandemic and the lockdown happened, the economic decline happened, recession happened, GDP growth dropped by negative by 10%. And so the central banks in response had to pump a lot of money into the system to support the economy. So you'll see here, 29 trillion was pumped into the system by the G4 central banks. And that somehow went into the pockets of people during the pandemic, and after the pandemic went on a shopping spree. And that was very evident in the US economy when you see second-hand cars are rising, and then you have wages rising also. And that's due in part to the too much cash in circulation that were injected by the central banks. So after that, the Black Swan event happened. After this cash injection, helicopter cash, we saw the Russia-Ukraine war happening February 24. And what happened? So the central banks had also its own share of war. It's war against inflation. The sanctions and the high oil prices are contributing to high inflation. So it's something that we should keep in mind, that for as long as inflation is there, it's going to be negative for the market. But the good news is at some point inflation is going to peak. And that is what we should be watching out for. The peaking of inflation and also the peaking of the policy tightening by the central bank and by the Fed. So what makes me confident that you should stay invested? It's the fact that GDP is growing very strong. First quarter, 8.3%. This is the fastest in Asia. And it is not a blip because we have been on the growth path since way back, several quarters, 80 quarters of growth at the level of 5% to 6%, and we're aiming for like 6 to 7% this year. And then next year, same level, 6% according to government. So you should stay invested because there is growth in the system. I don't think we're going to be going back into recession because we are in alert level 1. The economy is open, and that's good for economic activities. So aside from the growth trajectory, you'll see that corporate earnings also have been a mixed bag, meaning they're not so disappointing. Some have recorded above expectation, mostly in line. Very few are below. So it's very encouraging to invest in local companies. So, and the very good news is that the PSA movement follows the GDP trajectory. So this slide will show you that for as long as you have growth in the system, GDP growth, the PSA will be buoyant and the PSA will rise. So you'll see here on the right that economic growth shrunk and you see the PSA going down. So right now, inflation is the problem. Inflation will always be negative for growth. But you see that this year, the forecast of government is that we will still be able to achieve 7% GDP growth. And that makes me confident that playing the stock market, choosing the right investment outlets and vehicles is still worth your while. Okay, so aside from the growth trajectory, the economic reforms are in place. Hopefully, the new administration is going to continue them. This is very important for foreign direct investments. Comprehensive tax reform, the Financial Institutions Transfer, Public Service Act, all of these market liberalizing initiatives of the governments and reforms. These are all going to help attract foreign investments. And we need foreign investments to drive growth in this country. It's not only consumption, it's not only industry, it's not only manufacturing, but the inflow of foreign investments to fund our much needed expansion in several industries. It cannot be just government doing the infrastructure. It should be foreign investors, local investors within the PPP, public-private partnership project model for our infrastructure. So that's just one avenue for growth. You'll see that our rising FDIs it happened even during 2021, 10.5 billion US dollars, even higher than the pre-pandemic 2017, 10.3. You'll see here. And now we are still enjoying growth in our OFW remittances, 2%, 2 to 3% in the first quarter. Our BPO sector is projected to grow by 7%. So there are very few reasons why you should not remain invested. We still have growth and the foundations have been laid for the economy to grow. Okay, so this is the headwind. Rising interest rates, short end and the long end of the curve rising, and there is this news in the US that they could be in a recession next year. But the good news is that even if the US enters into a recession, it is not seen to be a very deep, a very harsh recession. It's going to be something that's going to be mild and it's going to be very short. Why? Because the US economy is on a very strong footing. GDP growth, yes, it has contracted in the first quarter, but the labor sector is fully filled. There is no slack, very high employment levels, 3.5%, back to the pre-pandemic, and they will be able to withstand. That is the forecast. And if ever recession happens, it's going to be very short and very shallow. But that's not the baseline scenario. The baseline scenario is that growth will continue in the US. Okay, so what's now the strategy if the market is very volatile and there is a lot of risk of sentiment, very sentiment driven and not so much aligned with fundamentals? Because we saw in the first quarter GDP was 8.3 and yet the market collapsed to 6,500 level. So what does that mean? It means the market is very much sentiment driven, very sensitive. This is a very psychological game that's being played by the investors. They're so nervous, so filled with jitters because they don't know what's going to happen with inflation, how tight the BSP is going to raise the interest rates, and how long will the war in Ukraine last? What would be the end game of Mr. Putin? We don't know. And all of these are contributing to the negative sentiment. But if you're going to play the so-called teams of the market, you'll be able to even be ahead of the market and enjoy cash flow and passive income in the next few years. And this is how you should be looking at things in the market. Number one, you should choose stocks that are going to benefit from the commodity upcycle. And that means companies that are positioned in mining, companies that are positioned in agriculture, companies that are positioned in oil, in exploration, in energy. Then there is this theme about yield curve. So the yield curve, inflation is rising, interest rate is rising. So there is one sector that's going to benefit from rising interest rates, higher loan rates. You know what sector it is? Higher loan rates, but very low deposits. So they earn a bigger spread. And the economy is reopening, more demand for loans, credit cards, retail loans, institutional loans. So it's the banking sector that's going to be in the best position. And you'll see here that in terms of the price change, they have actually gone up. When the market peaked year to date at 7,500, BPI, Metrobank, and BDO were among and the best. You'll see here in my slide, the PSA peaked at 7,005. Year to date, it was up 5.33%. This is the model portfolio of First Metro Investment. What you see here is an outperformance. This is 7%, not bad compared to the PSA, which rose 5.33%. And what contributed to the outperformance? Because this portfolio played the theme, and the theme is all about the yield curve. And the sector benefiting from the yield curve rise is really the banking sector. And then this portfolio also played on the theme of commodity upcycle. What do we have here? We have Semirara and nickel outperforming. 22% year to date, and 18% year to date. And then later on, I'll tell you what else these stocks are giving you if you pick them up. I'm not recommending any stock. I'm just making you understand what would be the best sector and the best constituents of that sector. So on your right, you see the same set of performers are present. The banking sector, BDO, and then you'll see here Meralco. This is the power sector. It has pass-throughs. I haven't explained the pass-throughs. So there are companies that are able to weather the margin squeeze, the so-called raw material inputs rising, inability to pass on the added cost of higher raw materials. So there are companies that are shielded from that. Meralco is one. Even if fuel prices are rising, the same margins are being enjoyed by Meralco because it is a pass on to consumers. So it's a sort of a pricing power that this company enjoys. The same with the Aboitiz Equity Ventures, which owns majority of Aboitiz power. And of course, the other companies here would be about a reopening story and recovery by one is Jollibee. So the next slide would be about the same portfolio, showing that in the difficult environment of today, the same portfolio is still making 0.59. It's not negative. The broad market is negative, and yet this portfolio that plays the theme of the market is giving you a positive gain. So this is an outperformance inherent in the choice of the sectors. Ayan, okay. So the second strategy would be to go into dividend stocks. And you do not have to look so far. We have the PSE dividend index. They have just created this dividend index, and you'll see the names here on the left. And these are the names of the top performers in terms of the cash yield. They are giving the highest cash yield. So if you buy them, you will enjoy this cash stream, this dividend stream. So in a way, you are trying to lock in the gains already by buying these stocks. Don't worry about the capital appreciation potential, but you are just trying to enjoy some cash flow through the cash yield. And this is a certainty. So this is something that is sure, and this is something that you can already take advantage of. So these are the names of the highest paying dividend companies. And you'll see on your right that the same set of companies is also giving you capital appreciation. So it's double. The companies are giving you, these companies are giving you high dividends, and at the same time, over a period of time, the price gain is so high for Semirara, 55% year to date, for nickel, 30%, and yet they are also the best and highest paying companies in terms of their dividend, 4.5. Okay, so your mind should be focused on the dividend plays. Ayan, enjoying both the capital appreciation and the income stream that it gives you. Okay, so this is another strategy. You can put in your portfolio this emerging asset class, which is the REIT instrument. This is the easiest way to acquire real estate. You do not have to buy house and lot or acquire buildings. You can have buildings, and you can be a landlord by in effect acquiring shares of these companies which are managing rental properties. So income generating properties, they are very affordable. You go to the stock market and buy a REIT, field REIT. We have all of this REIT. I'll show you the performance of this asset class. It is stress-free because you do not need to rent out the system, the units yourself. You're actually just investing as a shareholder. It supports wealth creation, and there is this tax perks. So if you compare this with a regular bond, the bond is imposed a 20% withholding, but you are tax exempt if you are an OFW and buying a REIT. For an individual, you're taxed 10%, which is lower than the 20% of the bonds. And then if you're the institutional sponsor, zero tax. So this is the advantage. Look at the performance. A REIT, capital appreciation plus dividends. total of 55%. Where do you get this kind of return? You're missing out on so much if you don't have REIT in your portfolio. So the dividends alone are very attractive. 4%, 6%, 3%. This is based on the initial IPO price. And over the years, if you have bought them on the IPO date, you'll be getting this capital appreciation plus the cash yield. Very high for a REIT because they have done the most asset injection. And if you're going to look at the market capitalization of this REIT from the day where they were IPO'd, look at the huge jump, except for this one. Sorry. For PhilREIT, it's a jump. It's another jump for RCR, and then MREIT, and then CREIT. So all of these are expansion in the market cap, which is of course all about price appreciation. Comparing them with the parent, you'll be buying a REIT, compare it with the parent, the sponsor, which is Ayala Land. So you'll see here that from the date of the IPO, the appreciation of the REIT was 48% based on the last price. The parent, 33% on the day of the IPO of a REIT. It dropped over a period of until, I think this was updated until today. This is a drop from 33 to 28, 14% growth rate. You'll see they're all negative, the parent, because the attention of the investors is now in the REIT. This is a new emerging asset class and very interesting in terms of the dividend feature. And then, of course, if you combine the two, you'll see that you're ahead. 61% for a REIT. This is the total return since IPO. PhilREIT, RCR 14%, MREIT 9.3%, CREIT 2.5%. And compared to the parent, total return negative. So I'd rather be buying the REIT. Now, some people are saying, oh, why will you buy REIT? The interest rates are rising and the bonds are rising. But you've got to diversify. You cannot just be in all in certain stocks, all in bonds, all in other assets. You have to have these instruments that have the tax perks and at the same time have the upside in terms of the dividend yield. So it's the upside of the dividend yield. The dividend yield is usually 5%. From the time they floated, it's 5%. And it has grown like 10%. So it's worth watching how the dividend yield will grow as far as this REIT instrument is concerned. So what's buoying up the REIT sector? It's the resilient office sector of the Philippines. Occupants, BPO, very resilient. You look at the contractual lease rate, how it goes up, 3%, 5%. Occupancy rate, is it 99% occupied? Is it in high quality assets? Meaning the office sector is premium grade and it's in the PESA sector enjoying tax perks. So these are all the things that you may want to know about REITs. And then there is this dividend yield fund. So this is worth watching out for also. This is another very good investment opportunity. You'll see here so many. It can come in UITF, it can come in mutual fund, and you see the 1-year return, 24%, 9.6, 7.3 for Metro, 18%, 6%, 13%. This is over a period of 1 year, starting April of 2021 until end of April 21. So had you invested in these outlets, you could have gained. But had you invested in our back-tested FMIC stock picks announced last June, you could have made 28%, a shocking 28%, because this is really a play on the theme of the market. Okay, so this is another alternative asset. This is buying into the quality corporate names and then government securities, longer, 5 years, 7 years. And you'll see that now that interest rates have risen, look at the price. This is the column representing the price. The price have declined over a period of 3 months. Year to date, they are all in the red because they have declined. And they are now at bargain levels. They are worth revisiting because the yield The yield is rising 6%, 6.4 now, 6.1, 6.8%. So this is the yearly return that you are going to make if you buy at this level, 86%, meaning at discounted levels from the par. And this is an example of like a 10 million investment. You see here, say interest payments on your portfolio. So this is really better. This is better than cash. Don't put your, don't keep your cash. Okay, some people are saying, oh, we're going to trade the market. So I'm just warning, it's very dangerous. It's a psychological game. You may be getting in and out of the market and losing more than you know. It's for the people who get advanced training in technicals. Get your advanced training so you can day trade if you like. If you're prepared, if you're the risk seeker, thrill seeker. But I really don't recommend day trading. Okay. And for extra diversification, don't forget that the market has a chance to recover. And if it recovers, you should have something like this in your portfolio, ETF. We have this ETF instrument. You can buy it from First Metro Securities. First Metro Securities will help you. You can buy it from the board. The underlying assets are managed by our asset investment house, which is FAMI. So you need to have some level of diversification in case the market recovers, because this is the market. This is the PSE ETF, and it represents the market. So anything that suggests that recovery is on the way, you should have this in your portfolio. And we have the providers of everything that you need. We have FAMI, and we have, of course, our very own, you only need one, First Metro Securities. Thank you. That's the end of my presentation. Thank you, John.
Thank you, Miss Christy. Talagang punong-puno ang mga notes ng ating participants, from insights about the market cycles to industries and sectors to look out for. May mga specific examples pa. Before we end this session, I'd like to give you the floor if you have some tips pa na gustong ibigay sa ating mga audience, some key takeaways. Floor is yours,
okay. Stay invested. Don't keep your cash as cash. Make some money on your cash, but be careful. Get the passive income from the dividend-paying stocks, those that are playing the teams. The names are in our FMIC Capital Markets Briefing last January.
Yun, there you have it. Thank you again, Ms. Christy Ulang.
Deal with the best. FAMI and FMSBC, broker and fund manager. FAMI.
Ayan. All you need to do is take a look in one place. Sabi nga ni Miss Christy kanina. So, thank you, Miss Christy. Let's all give Miss Christy Ulang a virtual round of applause. And with that, I hope you learned something new today. And with that, we bring our webinar to a close. Thank you for spending your Friday afternoon with us. Before we end, let me leave you with these very famous words from Warren Buffett. Be greedy when others are fearful, and be fearful when others are greedy. Cliché na yan, marami nang gumamit yan, but very applicable in our investment journey. So again, this is your host, John Garcia. Stay tuned in our Facebook page for updates on our next webinar. I'll see you again next time.